Prothom starts. We are looking at both year-to-date data and one full year of data. So we're going to go, Prothom is going to talk about the year-to-date data first. So that's just 2021. And then I'll be talking about the one full year of data. So Prothom, go ahead whenever you're ready.
Alrighty, thank you, Chris. Good afternoon, members of the board and UWL faculty. My name is Crosse, and today my team and I are here to sort of discuss the Gordon Spellman Fund. We've been tracking it alongside the market for over the past year, and now honestly we just want to share some of our key findings with you today, and then make some of our recommendations to readjust the fund so that it's best placed going forward for it to grow. Before we get started, I just wanted to clarify that we are going to be using the Telnet equal 500 benchmark throughout the entire presentation. And so before we get into the analysis, as you can see on this slide, here's the IMT for 2020. Unfortunately, we don't have two of our members present here today. We don't have Derek and we don't have Lizette. And so in place, we have their recordings for this presentation. And so here's Lizette, who's going to sort of give us a little bit of a summary about the fund over the past year.
Can I jump in, or wait till the end?
Sure. Yeah.
If you go back to the prior slide, I want to just help you. And I realize I didn't come in and guest speak on this. I actually thought what was said was very good. All right. This portfolio, if you look at it from the profitability, this is all I assume versus S&P 500. It's quite profitable, right? The first one, the P1 that you see there, is level of profitability, and P2 is growth. So it has better growth than the benchmark. That's why those are to the right, and it's more profitable. So these are quality companies, large cap quality companies. Bottom left, the annual return, it underperformed by 55%. That's 50 versus 65, bottom left in that table. Well, when the economy is rebounding, you wouldn't think people would rotate to safety. These are high profitability, relatively safe companies. Okay? I would think these kind of companies would underperform under that environment. So there's a story on this. Now, the vulnerability and variability, the first one I think is looking at just volatility of profit margin and stock returns. And the second one, the R2, is looking at how much debt you have versus the benchmark. So they are a little bit more risk from a financial perspective. On the valuation, which are the bottom ones, these companies are approximately the same price on various valuation ratios as the S&P 500. So you have better growth at a reasonable price, well, you do have more risk. If it weren't for the risk thing, I would say this performed exactly as I would expect in a rising market. Okay, because in a rising market, people rotate to junk that just survived the recession, all the cyclicals. All right, so I'll let you go now, but that's the explanation.
Hi, I'm Cole Greco, and I will be discussing the investment policy statement. So to start, we believe the investment policy statement should include more diversification in regard to the benchmark. Looking at the table to the left, we can see that our portfolio is heavily over-allocated in information technology and the communication services sectors. This leads us into our next investment policy statement recommendation, which would include a plus or minus 5% margin of error for sector holdings. We believe implementing this margin of error will have major benefits for our portfolio. Currently, our portfolio or our investment policy statement states that no individual sector should exceed 30% of the fund. So we believe adding this margin of error will lower the standard deviation and ultimately diversify the portfolio as a whole. Also, we will be able to receive a return closer to that of market returns for these sectors. One downside of this revision would be the number of securities within communication services and information technology that we would need to sell in order to fund new holdings in real estate, energy, and materials. However, this could be a phenomenal opportunity for our portfolio because these three segments have seen growth in the past few quarters. Just looking at the graphic to the left again, we can see the returns that we missed in the energy sector. And then just with these new revisions, we believe the portfolio will ultimately be stronger and create greater returns. So now I'm going to pass it over to Pratham to give an in-depth look at performance attribution.
I think you're on mute, Pratham.
I'm sorry, there you go. So I'll just start over. Thanks, Cole. And so I'm gonna just sort of discuss some of the performance attribution aspects now from the fund over the past year. And so looking at slide 9, some of the major contributors in the fund were the communication services and technology sector. Having said that, the total active return on the technology sector was actually down. It was negative 1.8%, whereas the communication services sector saw an active return of 0.7%. Looking a little further at some of the specific stocks, Applied Materials saw a huge return in 2020 with 55.26%. And then we also had Nexstar, Google, and Intel that also had some solid returns as well so far in 2020. The one surprise for us that we saw in the fund was the Turtle Beach Corporation, and it sort of continued to perform since last year, and even in 2020 so far has seen a a solid return of 18.89%. Those were some of the strong performances. We also had a few stocks that sort of struggled. Apple is sort of a big one because we have a large weight in the portfolio at 10.4%, and Apple saw only a minuscule return of 1.2%. The same thing goes for sort of even the communication sector. Qualcomm only saw, again, just a very small return in 2021. With that said, now I'm going to look at a little bit more in terms of the specific sectors in the fund. So as sort of Cole mentioned a little bit before, looking at the graph on the slide, energy was one of the sectors that we didn't have any holdings in, and it actually saw high returns in year to date. And so that's one of those sectors that we'll talk a little bit more about further in the presentation. Technology is another sector, like I've mentioned before. In this fund, it's been heavily allocated and has not seen much of a return in 2021 so far. Communications was another sector that has sort of thrived because of the Nexstar stock. And so for that reason, we also think it might be a little over allocated, and something we'll touch upon later in the presentation as well. And then finally, real estate was another sector that we saw valuable returns in 2021, but our fund does not have any holdings in real estate as of this moment. And so that's going to be another one where we feel like we should focus some allocation towards. With that said, here's Chris with some more performance attribution things to do with the fund.
Yeah, and quickly, just before we move on to applied materials, I don't know, I don't think we mentioned this at all, but Telemet, so the Telemet Finance Lab, which generated this visual, and most of the visuals in this presentation, includes applied materials in technology. So that's I mean, partially information technology is still really heavily allocated in the fund, but we also have to account for applied materials there. I just thought I'd make a note on that. And like Pratham alluded to, energy sector with their higher than average returns, or I mean, I should say their great performance in the past year. We'll be talking about that in our recommendations. So I'm looking at 1 full year of data here. So the following visuals are for 1 full year of data. So that will be all the way back to last May. And I think when you consider what's happened, everything that's happened since then, we've seen a pretty good rebound from the COVID-19 pandemic, but there are still companies like Boeing, which I will mention, that we're still lacking throughout the summer and the fall. So yeah, this is obviously a different story than what Pratham showed you before. And you can still see that information technology and communication services are largest contributors. And that doesn't mean that information technology is contributing all positive returns. When you look at the graph on the right, you can see that communication services has had the most positive total effect on our portfolio, while information technology is a little bit farther down the scale, but still a positive return in general too. Something that was really interesting to me, and I think the other club members, was utilities. And considering how many funds we have in utilities, it's just one, it's NextEra Energy. They've had a pretty good positive impact. NextEra Energy has had a pretty good positive impact on the portfolio in 1 full year. So, and I'll talk about that too in our selection effect, and that'll be very clear with that visual. So moving on here, yeah, so Turtle Beach Corporation, they've had over 200% return in the past year, and this was a company I was tracking throughout the course of the summer, and of course the fall too. And I remember, it's funny because I remember at 116% return, I remember saying we should sell some Turtle Beach that's included in technology and lock in some of that return. Well, I was wrong, and that would have been a terrible idea because they've increased even more since then. But again, Apple, when you look at Apple in one full year, they've had a very strong return. And I think, too, when you look at their balance sheet and income statement, they've had a pretty good benefit from selling more PCs as a result of the work from home environment. So, I know Apple was mentioned as a possibility for being one of the stocks that would be sold to finance buying other companies. And I'll just go ahead and mention, they have had a good return, but they are still a very large part of the portfolio. And they're a reason that information technology is heavily allocated compared to the benchmark. And then, too, the last stock that I wanted to mention was Booking Holdings. And this was a company that was obviously very negatively impacted, just like Boeing as well, by the pandemic, and they've made a great rebound within one full year. So that's good news there. And then when we look at the stocks that haven't performed spectacular, it was very surprising to me to see Pfizer at the top of the list here in the past year. And they were the company they were the pharmaceutical firm to release the first COVID-19 pandemic vaccine with I should say, a pretty high efficacy rate. So it was shocking to see that they didn't have a spectacular return, as well as Johnson & Johnson too. So we're seeing some of these healthcare companies that have been lacking, and you can look at the visual on the left and see that their total effect has been negative. So Pfizer, Johnson & Johnson, and CVS. Otherwise, I know Pratham mentioned that consumer defense wasn't doing too well. Our two holdings in Coca-Cola, or I should say our two holdings, Coca-Cola and Procter & Gamble, haven't been performing spectacularly, although consumer defense stocks, along with utilities, are traditionally low risk, low beta. So they're not going to have like a high return because of that. And that's part of why NextEra Energy, a utility stock, was surprising because of its higher return.
Don't move if you're done with the slide. Are you done?
No, I'm done. Did you want to add something?
Yeah. So I think I mentored the group with Pfizer, and I tried to get them to quantify how much the vaccine would add to their company, and it didn't add much. Meaning this is a very large company, and they'll, I don't know, even if it's $1 billion, it's not very much for a very large company. And this is a reopening play, as you said. So the question really for your group, you can answer it at the very end. It's like, well, is it time to adjust? Let me also say something else. You said you thought you should sell Turtle Beach up 160%, and it went up, 25% more, because they actually get the 201%, 160 is 25%. You said that was a mistake. I'm not sure about that. And here's the reason why I say that. When you make a decision, this, by the way, comes from Howard Marks, who's very wise in saying these things, and I guess it's me too, but you can go read about what he says about it. If that was logical, well thought out, and there was good reason, and it went up, that could have been just bad luck. Or buying something and it going up, that doesn't mean it was a good decision. It could have been just lucky that this happened. So it's actually hard in the end to say, was that a good decision or not? Also, if we would have sold Turtle Beach, maybe we could have bought something else that went up 100%. Right?
Yeah, and I think part of my reasoning behind we should sell Turtle Beach was the number itself, because when you see 116 or 115% return, you're like, is that sustainable in the long term? And my initial thought was, no, that's probably not a sustainable annual return for a company that, and again, I'll mention I'm not overly familiar with their business line, but my understanding, and I know that Turtle Beach sells headphones for gaming systems. So I think because of that, seeing that number, I was under the impression that if we sell this now, we can lock in those returns, kind of like taking chips off the table in poker. But yeah, I mean, I guess too, I'm not overly familiar with the business line, and what other products they offer, and so
it was presented 2 years ago. I worked at the group, and my father even bought it. So this fund's named after my father and grandfather. So he says thank you to the students. But it's a very small company, kind of, headphones, maybe getting into directional acoustics. But the stock was going down a lot during the pandemic, and then it bottomed when some news came out that people were doing way more gaming online, of course, and they need to go buy their new headphones. So, all right, I'll let you go. I'll be quiet again for a little bit.
All right. We're almost done too, so we've got 3 more slides left here. Okay, so yeah, this was, and again, this is in similar format to what Pratham started with in the year-to-date data. Again, I can't stress enough, I really do feel like we're missing out we're missing out on returns in energy. So we can see that since this pandemic has started, there have been higher returns in most sectors. So if you look at what the benchmark return, which would be on the right side of that visual, the benchmark return in red, you can see that it's higher than average. And materials, too, has had a pretty great and strong rebound. So I'm coming back to utilities here, and they were the only sector in our fund that was, so the only sector within the Gordon Spellman fund that was outperforming its benchmark. And so that is that NextEra Energy. So yeah, that's, again, NextEra Energy is very heavily focused on renewable energy sources. So that's another justification behind what Derek is going to recommend at the end. Another justification behind diversifying into the energy sector. See, I mentioned that materials too rebounded well as predicted, and obviously that sector is more determinant on the rate of recovery of the country as a whole. Like it's pretty straightforward. If the market is down, people aren't buying homes, and I just think of buying lumber and materials too to buy a home. But now that the market's up, we see that the price of wood skyrocketed in April 2021. So we're going to go ahead and move on to the last visual here. And I'll be completely transparent. We had a little bit of difficulty interpreting this graph. So, I mean, bear with me here, and I think I have the right interpretation down. But feel free to correct me if I'm totally off the ball on this. So we can see that looking at total effect, industrials, the companies that we chose within industrials, primarily the selection of Boeing, has had a negative impact. And on the flip side, stocks and utilities have had a positive impact. If we look at the selection effect, the blue bar chart in the middle, we can see that is very clear that utilities has had the only positive impact in the past year. Mind you, this is just past year data, so 1 full year. This is not the portfolio from when it started until now. And when you look at the overall selection effect, our stock that has impacted the portfolio most has been NextEra Energy. So allocation effect to the yellow bar chart on the left, we can see that because we've allocated the way we have in communication services, that this has positively impacted in a total sense, as well as that same interpretation applies for information technology. And the fact that we didn't pick anything in real estate has positively impacted our portfolio as well. So those are all the visuals we're going to discuss today, and we're going to go ahead and move it into, Derek is going to talk about our recommendations and moving forward. Yeah, and quickly before we conclude here, I don't want to go over time too much. And going along with that energy sector allocation, we as a team discussed with Dr. Stivers, and this is not a steadfast, only renewable energy can be added to the portfolio. I think when you look at like the electric vehicle market, for example, yeah, that's great, and there's great projection in the future, great possibility in the future for growth. But it's going to take the world a long time to transition from, let's say, non-renewable fossil fuel to that electric renewable energy market. So I know that there are two teams pitching two non-renewable fossil fuel companies. I believe it was Chevron and then another transportation company. And we're not like closed off to that. And I think too that would be a really strong addition because they are energy stocks. And I'm sure that even non-renewable companies have seen a good portion of increase in return there. So I just wanted to clarify that too. And that was something we went over. So that is our presentation, and that's for the past year what we've been looking at. We've obviously been breaking it down into a sector level, and we've been looking at those companies individually to see which companies and the securities have contributed the most to our fund in both positive and negative light. So now we're going to open it up to questions from you all. Yeah, and thank you for listening.
I'd like to do one more, and I'll let others talk. First of all, I really like this. All right, I'm really pleased that you put this together, and what you put together, I'm quite pleased. Okay, I want to point out, if we would have invested in renewables, that is not the energy that we missed out on. It was oil prices going from negative back to a reasonable oil price, and all the ones that are dirty oil, those are the ones that are up 150% or so. If you went into renewables, that's gaining our exposure in this portfolio to something completely different than what we lost out on. So I don't, if you say we're underweight energy and we lost out on that, replacing with renewables would not do that. Okay. That sector is moving more towards renewables, but renewables is still a tiny portion. I'm not even sure it's part of the energy sector. It could be part of the utility sector, someplace else. Okay, so that's my comment. Thank you, and I thought it was a really great job.
Thank you for your input too. Yeah, it's appreciated.
So we have about 8 minutes for questions. Anyone have any questions?
Yeah, I can jump in here.
Sure. Oh, go ahead.
Hey everyone, this is Brandon. At the beginning, you talked about the IPS, and I think you mentioned that the IPS benchmark is the S&P 500, which would be market cap weighted. But I guess my question is, when you are showing these graphs, I think there was a mention of using an equal weighted S&P 500. Is that accurate?
Yeah, so we use Telemet to do this analysis, and Telemet provides us one benchmark, and that's their Telemet 500 equal weights benchmark, which is similar to the S&P 500, but again, it's not the same. So it's kind of like having a seafood. Yeah.
Actually, it'll be a lot different. It actually be a lot different. I missed that part. Could they have just used an ETF SPY and entered it in there? Tracks the S&P 500. I'm asking you, Professor.
I don't think they would have been able to do the specific things in Telemet, and it's just an unfortunate thing that the not basic, but the version of Telemet we have only has this equal weighted benchmark, and to get the Standard & Poor's benchmarks, you have to purchase all of them, and it's like $1,800 for one user for the year.
Yeah, I understand. We can't get the actual index, and actually, you don't have to pay for it. You can ask very, very, very nicely, and they give it to you for free. So I've done that. That's how we get it. We don't pay for those benchmarks, but I can maybe talk to you about that later. Russell won't do that now. You have to barter with them or pay them a ton of money, and it's way more than 1,000. But you could just type in SPY if you can do the portfolio to another benchmark. Like SPY is a free ETF, and if that is allowed just to put in a benchmark, that would solve the problem. Because SPY is an ETF that supposedly tracks the S&P 500, it'd probably be better. And sorry, it was only 8 minutes before I started, so I better stop.
Yeah, I appreciate the analysis, well done, accurate analysis. I think it would be a slightly different conclusion if you were able to use the market cap weighted. For example, the technology weighting in the market cap is closer to 26% from the 15 roughly that you're showing here. So can make some significant differences in some of the analysis, but otherwise I appreciate the work.
Thank you.
Now, I would just follow up and say, I think everything was fantastic. These are exactly, when you talk about attribution, this is what I do in my career, trying to explain why we outperformed or underperformed to clients or prospective clients. You guys have a good grasp of that. I would just say a couple things to think about in this world where a lot are moving to index products versus active management. There's always that constant debate. It's interesting to hear, particularly on this slide, when you talk about maybe moving to more index-like. There's nothing wrong with that. The index does tend to outperform a lot of active managers, but it's just interesting to think about. I think the active managers that are surviving in today's world are the ones that have a lot of flexibility, maybe fall into the unconstrained camp. And that's really how it seemed to me that this is how it was set up. And you pointed out it really didn't allow you to outperform, or we weren't able to take advantage of that. But I think that's something to keep in mind. And you do have a plus or minus 5%, so I don't think that's anything too crazy. I don't think you hamstrung anyone here. And I think all what you put together are good points. But it's just interesting to think about that from a perspective, in the industry. That's really what active managers, they need some kind of levers to pull to distinguish themselves from others. Now, you can win big, but you can also lose big as well. So it really depends on who you're talking to and what they want. I'm not saying it's right or wrong, just something to think about. But I thought what you guys put together was great. I apologize, I couldn't hear all of it. I think the recorded sessions, for some reason, it's probably a tech issue on my side that I'm not smart enough to figure out. But I wasn't able to hear those, but I thought you guys did a great job.
Thank you. Were other people able to hear those recordings? I'm just curious. Okay.
I could hear the first couple, but for some reason I couldn't hear the last one.
Okay.
Sorry, and just one last thing, and I think you might have covered it when you talk about ESG or renewables. That's obviously a big thing today in the market, and it's, I mentioned I'm on the bond side more with credit ratings, and ESG, the information is probably where it was 30 years ago when we talk about credit ratings. I've read some stats that 90% of the information is a year dated, so it's stale. All management companies are saying they're doing the right thing or trying to move that way, but in order to manage, you have to be aware of the constraints. Maybe tobacco stocks, maybe other stocks are going to be out of favor. I don't know if you want, again, to hamstring the portfolio and require it, or not allow certain sectors, but just, again, something to think about. I would say be ESG aware that there might be downward pressure on certain sectors or names. Energy falls into this. Be aware that there may be pressure on those sectors and not others. And then, you raise a good point, energy, and it was good dialogue. It has taken off mostly because of oil coming. Everybody thought Biden was going to be more difficult, but reducing the supply actually helps in this case. But I think it's interesting to think, if you look back at energy, you have to go a ways back. They did have their run. So they're still probably, you could argue, maybe recovering from some of that prior downfall. But anyway, I thought it was great, and I'll get off my box there.
Yeah, I would just add on to that. Am I getting a lot of feedback here?
No, on my end, you're fine.
Okay, I guess I'm getting it on my headphones then. With the attribution analysis, just kind of pointing out a little bit to what Brandon said and Kevin pointed out with the equal weight versus the market weight. The S&P 500, the top 10 stocks make up 25% of the index, whereas an equal weight, all 500 stocks are going to be 0.2% essentially. So, Apple and Microsoft are the two biggest, and they make up over 11% of the index itself. Whereas in the equal weight, they're only going to be 0.4%, those two stocks. So that just gives you a little bit of context around how big the variance will be between equal weight and a market cap weight index like the S&P 500.
Adam, I know the ISS EVA has all the indices in there, and I don't remember if you can actually just show the return over the last year, but there's a possibility you can. You maybe want to explore that product, so at least we could have the top line number versus the S&P 500.
Yeah. Okay. Yeah, and we can chat another time about trying to get the S&P benchmarks. But well, we're at the time there, so we should probably move on to the next presentation. But great job by the investment management team from the club, and again, some of them should hopefully be back for next semester, and we'll hopefully have this presentation every semester now. So great job.
Yeah, thank you all for your time. We appreciate it.
Thank you again.
Thanks, guys.
All right, take care.
So now we'll be moving on to the class presentations. The first one we have up, American Tower Corp. And for all the board members and the UWL faculty that are attending, if you'll follow that link I provided to score the presentations, would be appreciated. And with that, I'll turn it over to our first group from the class today.
Good. Thank you. Give me 1 second. I'm going to get this PowerPoint or the slideshow uploaded so you guys can see it. That might help.
And one other thing, just we should probably hold questions until the end for each presentation, just for the sake of time.
Okay, is everyone seeing it?
Yeah, go ahead.
Awesome, let's do it.
All right, let's do it. So we did American Tower Corporation, and I am Brandon Hudson.
I'm Josh Gableman.
I'm Luke Eldine.
And I'm Nick Shoup.
American Tower Corporation is a REIT that owns and leases wireless communication infrastructure. They're based out of Boston, Massachusetts. They currently have the largest market share in the United States at about 33%. We're recommending a strong buy. They're currently trading at $248. Our target price is $310 with a target return of 27%. And then through our presentation, we'll go over their business overview and their financials. We'll tell you guys what we think their key drivers are and go over their risks. So American Tower's yearly range is 197 to 272. Their trailing 12 months FFO per share is 8.65, with a market cap of 107 billion. So going over our presentation here, we'll first go down, we'll break down the revenues, we'll go over their financials, touch on our key growth drivers, which are their increases in margins, tower and lease growth, and then we'll go over our valuation, risks, portfolio fit, our recommendation of a buy, and why we recommend a buy, and then wrap it up with a summary at the end.
So going over the business overview, AMT is a REIT, and it leases telecommunication sites to companies like AT&T, Verizon, and then many others overseas in other countries in order to expand the mobile technology reach. So AMT's primary goals is they just own, operate, and develop sites intended for multiple tenants. They operate in countries like North America, Latin America, Asia, Middle East, Africa, and Europe. So they have four main pillars in their business model, and that is operational performance. They grow assets capabilities, expanding platforms, and driving industry dividends. So AMT owns a number of sites, and it's over 185,000 worldwide. That's 43,000 in the United States alone, and then 142,000 internationally. So they do have global presence.
And then looking over their revenue streams, so their revenue has increased for the last 15 years in a row, and their dividend has also increased over the last 11 years in a row. Their current dividend yield is at 1.99%. And we can see here that the majority of the revenue comes from the United States and Canada or North America. But I'd also like to add that recently they have started major growth and development in countries such as Brazil and India. The revenue streams might not reflect that because those are quite new developments. And over the next few years here, we'll begin to start see the revenue from those regions greatly improve and greatly grow. And then going over their financials here, I would really like to look at their FFO per share. So their trailing 12 months is currently at 8.65, and we can compare that to their top two competitors of Crown Castle and SBA. Crown Castle and SBA are the other top two leaders in the United States here. They have the second and third largest market share. And then I'd also really like to look at their net profit margin. And we can see from 2018 to 2020, their net profit margin has been vastly larger or sizably larger than their top two competitors in the industry as a whole.
All right, so moving into the first growth driver, we're looking at the tower and lease growth. So we already know that 99% of AMT's revenue is coming from their leases, from their tower leases. So we thought it was important to look at how many leases they expect to be growing by in the next couple of years. So in the past 5 years, they've added over 100,000 new sites. And then from their earnings call, we heard that they expect to see 40 to 50,000 new sites in the next 5 years. That's globally. And recently in 2021, they made a deal with Telxius, however you want to say it, to acquire $31,000 across Germany, Spain, Brazil, Chile, Peru, and Argentina, again expanding their global presence. We found out that each additional tower adds roughly 15,000 to the total FFO, and it's projected to add around 900 million by 2030. So looking at this figure 5 projected number of towers, you can see that in 2021 they're going to be adding those additional 30,000 new towers from the Telxius deal, and for the next 4 years following, another 10,000 each year, and then a conservative guess of around 4,000 each year up until 2030. So we can see that going from what they have now of 180 to almost 200 to about 270,000 by 2030. So now looking at the lease growth, this is another key driver for them. Their contracts typically last around 5 to 10 years, and these are, for the most part, non-cancelable, which is very good for us too. With 65% of the tenants having already signed for renewal date of 2025 or later. It is very expensive for these telecommunication companies to remove their equipment from AMT's towers, and most of the telecommunication companies find that it is in their best interest just to rent the space from AMT because they do not have the financial capability to create their own towers and run their own towers. So the majority of the growth in revenues have already been guaranteed through 2027. So this guarantees us income. We know that they're going to be getting money. They know that they're making money. So that's around $60 billion worth already. Typically, rent has increased around 5% over the past 5 years. This is typical with real estate and with property. So that's a good growth rate, 5%, and it's pretty consistent. So we don't think that's going to change for quite a while yet. We also expect an 8% increase in the number of tenants per tower due to the mobile data increase. This is especially important in the United States with 5G. As most of you know, the 5G towers, their wavelengths do not reach as far as 4G. I believe 4G is somewhere around 10 miles and 5G was maybe a half a mile. So they're going to be implementing more towers for 5G, and they're going to be adding more tenants to these towers. We also have the very low churn rate, only around 1%. And I'm going to be passing it off to Luke. He's going to be talking about the second driver.
Yeah, so I'm excited to share with you how we expect our margins to increase. So why are these margins going to be increasing? This is going to be due to mobile data usage going up, and also due to the accessibility to mobile devices, especially in emerging markets where people are starting to be able to buy smartphones and get devices where they're able to use mobile data. And another reason why we're going to see increases in mobile data usage is because a lot of the content that people are using is highly intensive for that data, and that's like videos and any streaming you do. It takes a lot of mobile data to be able to communicate that to you. So internationally, we're going to see about a 30% increase in mobile data usage, and domestically about 24%. And this means that telecom providers are going to have to expand their coverage and expand their capacity to meet these requirements for this mobile data usage. And what does this mean for American Tower then? This means that they're going to have additional tenants each with this mobile increase. And I would like to point out figure 5 here, and this has come from their tower investor presentations. So we see a large increase from 1 tenant to 2 tenant on our gross margin, and a moderate increase from 2 tenants to 3 tenants. And that's really going to have a large effect on our ability to generate more FFO per share. So this is showing us a little bit of how devices are going to be using data and how it's going to be growing. So an interesting thing to point out here is that it's growing about 27% annually for the next 5 years. After the 5-year period, there's a lot of uncertainty concerning about how much data is going to be used, because when you move from a 4G to a 5G, when a new deployment of a generation is rolled out, there is usually a huge increase in the amount of data that is used, and there are a lot of predictions that don't necessarily show great things. And another thing I want to point out here is the Internet of Things, and that is simply a lot of things are going to have sensors in them now that are going to be able to communicate with one another, telling them, and an example of this will be our cars in the future are going to have sensors in them using mobile data so that they're communicating with each other when they're driving on the highway so they don't crash. And who's going to be able to support this mobile data usage? What are the necessary components? The number one necessary component is the critical infrastructure that American Tower is going to be able to provide for this growth in mobile data usage. So to get into some of the numbers here, there are a lot of assumptions and a lot of calculations that went into these numbers, and I would be happy to answer any questions at the end of where these are coming from. But currently, we estimated that there is about 1.9 tenants per tower in the United States and 1.8 internationally. And for the next 5 years, we expect a growth of about 8% for our tenants. This growth number is coming from their competitor stated that they're able to add about 1 tenant every 10 years, so about a tenth of a tenant a year. And we wanted to be a little conservative, so we scaled it back to 8%. After those 5-year period, we expect a 5% growth rate. And then after that 5-year period, 1% domestically and 2% internationally. And those numbers are scaled back because there's a lot of uncertainty concerning the deployment of 5G and how small cells or how macro sites are going to be used for this. And for 5G, there are 3 different band wavelengths that are used, and one of them is a low band, mid band, and high band. High band is for that really urban, dense areas where you're going to have super fast speeds. Low band is for a larger area, and this mid band is really where the telecommunication providers want to be, because you have the best of both worlds. You have a little bit more space where it can travel, and it also provides you that fast speeds. And if we were to take this average of the 15-year period here, the change in FFO, this number results in about a 13.5% increase in our FFO per year, which is really going to be driving this growth for American Tower.
So diving into a little bit of the valuation here, we wanted to project the FFO per share for the next 5 years or so, and we took that 13.5% average increase, and we applied it to their current FFO of 8.52. So we can see how much that increases every year, and it will continue to increase. But we also gave you a pessimistic estimate and an optimistic estimate as well. But so from there, I want to dive into this the dividend discount model. So in order to construct this, what I did was find their FFO per share for our estimates for the next 5 years or so, multiply that by the payout ratio in order to get our dividends from 2021 until 2024. In the top left, you see the beta, market premium, risk-free rate, and term growth. So all our inputs are up there. We did adjust the beta a little bit because we thought the cost of capital was a little higher than what that was suggesting. And if we left it at the current beta of close to 0.22, we got a present value of over like 1,500. So we didn't find that was very accurate. So then going from 2025 till 2035, you can see that the dividend growth rates starts to slow down a bit, and then we hit that 2036, and we hit our constant growth period of about the 3% dividend growth. All of this gave us a present value of the cash flow of $438.
So another method that we used to evaluate the company was a price to FFO valuation model. And these numbers are suggesting that we're going to be growing at a nice rate. And to find this target price is more of like an intrinsic value of the company rather than an exact target price of the next year. So to find these numbers, we took an average for the 4 years for FFO per share, and then an average price to FFO per share. And we got 1288 and 1988, and this results in a price of $256.
So then, based off of those two estimates, we were able to make a few price projections here. So focusing up on the top right-hand side of the screen, we thought that the value we got from the dividend discount model was a little too high. So we decided to only weigh that for 30% and then take and 70% for the P to FFO ratio. We found those weighted averages, and we were able to come up with a target price of $310 and that would give us a 27% return from what AMT's current price is. We also gave another pessimistic and optimistic estimates as well. And yeah, those are all the numbers. So from there, we will dive into a few risks of the company.
All right, so looking at some of the risks that AMT might get into in the future, probably the most unavoidable risk is the inflation and interest rates that are going to be rising. So that is something that will most likely happen, and it's kind of unavoidable. So we need to take that into account. Merger and acquisitions are popular in some of these REITs. So that's something also we have to watch out for. ground lease agreements, that could also be, something that we could see some tenants not, applying back into our company and signing somewhere else. The increased churn rate, like Josh said before, our churn rate is pretty low, so I don't see that, being a very big risk, but it is something we need to keep in mind. And then things like natural disasters, pretty rare, but it's always in the back burner. Decrease in demand for infrastructure. In the next 10, 20, 30 years, I don't see that going away unless satellite usage became more popular. And then high levels of debt is something that we could see if expansion is going to be happening. And then we'll be looking at the portfolio fit now. So after constructing our correlation matrix, we saw two notable stocks in the portfolio that have the highest correlation, and that is Next Era Energy, that ticker is NEE, and then Coca-Cola, KO. And we saw those as the biggest correlations in the fund there. So looking at that, we think it would be a smart decision to sell off some of the shares of Next Era Energy. And we concluded about 90 shares, which would be a $6,900 value. And then 95 shares of Coca-Cola, that'd be a $5,100 value. So then that would leave us about $1,200 to buy 48 shares of AMT. Now, if we did the class consensus and sold the shares that they concluded on, that would leave us about $13,000 in extra cash for other investments. And in total, if we bought the 48 shares of AMT, that would be about 2.8% of the portfolio value.
To summarize here, I really want to make clear that AMT is positioned effectively to capture the growth that is going to be happening in the telecommunications and the mobile data industry and all of that. And an important thing is that they're globally diversified. So the American market's a little bit more mature and the growth might be a little slower, but these emerging markets, there is a lot of growth potential that is able to happen there. And it's a good place to be, and they are positioned effectively there. They are expecting to build about 5,000 or 50,000 more towers over the next 5 years, and we're expecting an increasing dividend payout, and we also expect our revenue to increase. This REIT will give us great exposure to real estate as well, because this isn't your typical REIT that is like office spaces or retail places. And this REIT gives us exposure to this critical infrastructure, and this infrastructure allows us to communicate with each other. And one of the most defining things of what being a human is, the most defining thing of humanity is our ability to communicate with each other. So American Tower gives us the backbone for us to innovate for the future. So they are positioned to help us do that. And because of this, we are recommending a buy of 48 shares of American Tower, and our target price was $310, and it's trading at about $248 right now. So we would expect a target return of 27% about. And we are open to any questions, and thank you for listening.
Yeah, thank you. We can answer any questions you guys have now.
Yeah, so we have about 18 minutes then for questions. Whoever would like to get us started.
Okay.
Hey guys, this is Tyler. I'm not sure if you can hear me okay.
Yeah, we got you.
Okay, perfect. I'm driving, so I wasn't able to look at the entire presentation, but I was able to hear all of it. I just had a couple of questions on the company structure. Let's just kind of talk about first with the tower itself. Do they just own the land? Do they own the tower? Do they own all the equipment in it? And then when we go through an upgrade cycle, 3G to 4G, 4G to 5G, and a future point to 6G or wherever we go, who's doing the upgrades? Because you hear the big telecom companies talking about the cost and the capital investments going from 4G to 5. Are they doing the upgrade, or is American Tower also, incurring some significant expenses going from 4G to 5G? So that's one question. I'll let you think about for a second. And then the other one is more of an observation or comment on one of your risks. You talked about inflation and interest rates, and I could see where interest rates would be a risk. But I just want to get your take on inflation. I would have actually viewed that as a positive for a company that owns land, owns real estate, and in terms of raising rent, if you will, being able to raise rent under the cover of broader inflation, seems as a positive to them. So I'll let you talk a little bit about why inflation was a risk, but then I want to also hear just a little more about how the company is structured in terms of their ownership of the assets they're renting.
So I'll jump in and talk about how their assets and the structure of the company a little bit there. And American Tower owns the tower, and they own about 10% of the land underneath the tower. The rest of the land that the towers are built on, they lease from people. And the equipment on the tower is the responsibility of the telecommunication provider to put that equipment on there and for them to take it off and take care of their equipment. So a reason why a lot of telecommunication providers don't take their equipment off is because there's an enormous switching cost from taking that equipment off and going somewhere else. And they also risk their coverage when they remove that equipment. So it provides AMT a little bit of an advantage for them to have those towers. So we thought inflation might cause us a little bit of a risk there, is because our
I was thinking, interest rates can affect, or inflation can affect interest rates. And therefore, if we have loans out for tower acquisitions and building towers, that would also affect, or just inflation in general would affect the interest rates of our loans there, which could therefore cause us to pay more per month in loan payments.
Got it. All right. Thanks, guys.
Yeah.
Yeah, thank you for the great question.
Hey
guys, this is okay. Hey guys, this is Eddie. Just a quick question, kind of back to the business model and the competition. So, if they are renting the land, or they own about 10% and they rent the rest of it, and you talked about the competitive landscape, I assume it's expensive, to relocate, like you said. But how easy is it for their customers to switch? Are all these competitors that close together, or is it really?
So their competitor is stated before. American Tower hasn't necessarily said this, but Crown Castle, their largest competitor in the United States, has stated that it takes the telecom provider about $40,000 to remove their equipment, and also by removing their equipment, they are risking their coverage. So they might get complaints from their customers.
Yeah, so that's why we also see so many tenants already re-signing for years beyond 2025. So.
Yeah, and with that too, like what we're saying is their American Tower's customers, like Verizon and AT&T, for example, they run into a lot of risk with the movement of their equipment, with the coverage, like they were saying. And then, but the biggest thing too is the cost outweighs the benefit for them. The cost of removing that and relocating to another site outweighs the benefits of just simply going to another company or to another tower.
Okay, good answers. Just to kind of to go back on that. So if AMT is leasing 90% of their land, I assume, are these like 30 to 50-year leases?
Yeah, they are.
Okay. Okay. And then here's kind of an off-the-wall question, but if you think about technology risk here, you think about the old phone companies, using, cellular phones to talk. Maybe that's not a good example. Landlines, and then all of a sudden we do over the internet. is there a technology risk where we can, like, I totally believe in the theory that people are going to use more mobile. There's all that data, like I get it. But is there a way to compress that? Is that an additional factor that could help this company because they're set up to get that new technology? I realize they don't have the technology, but or is that a competitive threat where they won't be needed anymore?
So they're actually starting to explore edge computing, and I didn't have enough time to really dive deep into their exploration of edge computing and how that's going to relate to all of the risks revolved around technology. But they are starting to position themselves for that, and they do see the future of satellites talking more and all of that. So there is some risk concerning that, but they expect that most of their macro sites are going to be needed for at least another 20 years because they roll out new generations of technology, there is usually a slow uptake of that. So there is risk presented there. So.
Okay, no, hey, you guys did a great job. The only other thing I was going to add was, AMT, we actually own the bonds for the company that I work for. So when you talked about the risk of inflation, and I don't even know the answer, I have to look this up if they have a lot of loans, but we buy a lot of their 10, 30-year debt. So the risk for inflation from that standpoint, will take time to play out, and they can probably, if they see that we're really going to have a rise in rates, they could lock in a lot of, long-term debt pretty quickly. So I don't know if they have a lot of different loans that I didn't realize, but that to me didn't quite seem like that big of a risk, similar to Tyler's point. But I thought you guys did a great job. It is a good company, huge price to book, but that's the whole industry.
Mm-hmm.
A nice job.
All right. So yeah, I mean, I guess maybe that inflation isn't as big of a risk as we thought. So that's another positive for us.
I guess I was thinking that also AMT would be able to increase their prices quickly. But I do know, the Verizons of the world and all those guys continue to compete on price, and they have not been able to increase prices much. So maybe there is something to it, because they're going to get pushback on their customers.
Mm-hmm. Yeah, very good point.
So I'm going to ask a question, or can you, as you go to the slide, go to the slide where you showed the final FFO, the 14% or whatever. I will talk about inflation. It's something, this was a team I mentored. I may have mentioned it to you very briefly, but for a REIT, inflation is a risk. Obviously they can increase the rents if inflation goes up, but REITs pay a pretty high dividend yield. This one's not as high, and they tend to do very poorly when interest rates rise. If you think about it, if the safe asset 10-year bond goes up, and you're buying this partly for the yield, that some other assets, yielding more. So you may have people move out of REITs into that. With that being said, I think you're buying this more for growth than for the yield. I will comment that, and I sent you an email. I thought you did a very, very nice job. Can you very succinctly on this slide quantify, and I know you've already done it because you did the model, how much of this growth comes from new towers? How much it comes from rising margins because you have more people on towers? So there's rising margin and rising sales from more people on towers. And how much does it come from just the price increase that you're charging for rents? Because I know all three of them add up to this 14%, but I think if you do this, I actually already kind of done it in my head. So I know the answer and that this is a believable number, but I think if you do this for others, they'll be more believing. So it's new towers, it's more people on each tower, is price increases, and when you get more people on a tower, margins go up.
Exactly.
So can you quantify those four things?
So you're saying how much
of the growth of the 14%?
Of the 14%, what each is? Okay, I see what you're saying. Yeah. So I would majority of that growth, I would probably say is about 8% is coming from adding tenants. I would probably say about 2 to 3%.
A second, sorry, you said they add 8% tenants over the next 5 years. So 8% over 5 years is only 1.4% per year. So you said it was 14% per year is what this thing's growing. So it can't be that. Can't be 8 of 14. All right, I have to help you then. I thought you modeled it, but don't know. Go back 2 drivers. It's really simple. And it'd make your, all right, go back 1 more. You have 5% more, but you went too far.
Oh, yeah.
You have 5% more towers. So your sales go up 5%. Go 1 more slide. By the way, does anyone else want to give a try to this? So I just shot down one of the group members. By the way, I said you did a super job in my email to you. So this is 5% rent growth. Okay. So now we're at 10% bottom line, assuming margins don't change. You expect 8% increase in number of tenants over 5 years. So that's going to give you another 1.4%. Go to the next slide. And if you go from 1 to 2 tenants, it's twice as profitable. So that 1.4 is really more like 3%. And it's actually more because your interest and taxes below that number. So it's probably 5% there. So now you got 5, 5, 5, easily 15%. There's your answer.
Thanks for helping us out.
You saw 5% more towers, 5% higher prices. And you probably get 5% from this driver, along with the 8% increase. And then you add a few percent dividend yield on top of it. And you hope your price to FFO multiple doesn't go down. Okay, that's it.
Yeah, so I mean,
how many minutes are left?
Yeah, and that totally makes sense for me too, because that 13.5% that we got was an average for the next 5 years. So looking at this chart again, we can see in 2021, it's looking like close to 17%, and then dips down a little bit to 14, 10. Or sorry, that's okay. We don't have all the years in there, but
you modeled it out, so I thought you actually knew the answer. I thought you just add them, but I'm pretty sure you could actually figure out how much comes from each. Those are just approximations I did. But when I saw the slide, I'm like, oh, beautiful. And then I tried to back it out myself.
Adam, do we have time for another question?
So you know, I can't divide 8 by 5 years. I actually got to 1.2% in my email to you. When I started saying it here, I realized 8 divided by 5 is 1.4. So you have to adjust what I sent to you in the email.
Yeah, we have 3 more minutes for questions. Brandon, did you have something?
Yeah, I did. I just want to make a comment first. I appreciate the recognition of margins as a way for future growth. I think a lot of people think of new business lines or growing their existing business lines and forget about you can deliver bottom line growth by just improving your current business. So I appreciate that. A question related to that on slide 10, where you talk about the increase in margins based on tenants. What is the breakdown now in terms of towers? How many towers have just 1 tenant versus 2 versus 3?
So
right.
Go ahead, Josh.
I think right now their average tenant is about 1.8 tenants per tower.
Okay.
And we're going to continue to see that to grow with the increase in mobile data. Luke, do you want to add something?
Yeah, so that estimate comes from, so their gross margin right now is about 70%. So I took some weighted averages to find out what their estimate was. Back in 2017, they stated that they had 1.7 tenants per tower. So, and now we're in 2021. So I knew that 1.7 was a close estimate where it was going to be around. But after I did some calculations of one time to get 1.9 for my estimate of tenants per tower, if that makes sense.
Yes, thank you. Another quick question. So the current administration's proposing an infrastructure bill, and part of that is advancement of telecom to rural areas. Did that factor into any of your estimates, or have you found any conclusions on that, if that's a benefit or not to the company here?
We definitely see that as a benefit, but by the time we got that news, we were so far into this project that it was almost like too late, and we didn't have enough time to research into that completely. So.
Yeah, understood, and it's pretty early in terms of details anyway, but I'm just curious if you were able to relate anything, or if that was factored into some of your estimates.
It was factored in a little bit when I was calculating the amount of tenants and how many towers they were going to build domestically, but there was a lot of uncertainty around that, so I didn't take that into account too much.
Okay, thank you. Good job.
Thank you.
Anyone have one final quick question or comment? All right, well, we should probably move on to the next presentation then, but great job. And also just a reminder to our audience members, if you'll score the presentations as we go with the link that I provided. So now we have our next group, which will present on ETRN. So whenever you all are ready and someone can share the PowerPoint.
Okay, just checking everybody can see that okay?
Yeah, go ahead.
Okay, we are group 4. I am Quentin, joined by Sam, Chasten, and Hassam. And today we're going to be walking you through our research project on Equitrans midstream. So we are recommending a buy on Equitrans of 500 shares. And currently we believe they're very undervalued. And we believe their Mountain Valley pipeline will provide massive growth for them upon completion in 2022. And we believe that America's need for clean burning energy will continue to grow over the next several years. So our target price for ETRN is $9.55. So that is a target return of 27% when considering their price of $8.02 currently. Now, they operate in the oil and gas midstream industry in the energy sector. And they are in the Appalachian region, so the East Coast. So some challenges for them so far have been their water crossing permits. And an opportunity for them is, again, that Mountain Valley pipeline, which is said to be completed in early 2022. Also, their merger with EQT is a big growth opportunity for them, which is their upstream provider. Now, their key growth drivers are going to be their gathering operations, which makes up about 67% of their revenue in 2020. And they have around 1,100 miles of high pressure pipeline for these gathering lines. The second key driver for them is their transmission operations. This makes up about 26% of their revenue in 2020. And they have 950 miles of interstate pipeline that connect to their local distribution channels, or the downstreams of the natural gas value chain. Now, some risk involved with Equitrans is their permitting issues, as previously mentioned, with the Mountain Valley pipeline. Their problem right now is that they have to get a permit for every body of water that they cross. They were shooting for one large permit that would cover every single body of water, but that got denied. So now they need one to cross each of those little streams, creeks, and ponds. Another risk for them could be contracting issues with upstream and downstream. and then alternative energy sources that arise in the future. So here we can see in figure 1, this is their year-to-date stock price. So in early January, it was up around 825, almost up, or excuse me, 850, almost up to $9. And it stays around in that range throughout this year, never dipping below 750, but also never going above $9. And here we have some key statistics for Equitrans. So their PE ratio in the trailing 12 months has been around 750. Now this signifies that they are in fact undervalued at this point in time, and that rings true for 2020 as well. They had a rough year in 2019. That's when they were facing a lot of debts with the MVP. And then, as we can see, their return on equity has been fairly good as well through the trailing 12 months and 2020. Earnings per share right at around $1 for both trailing 12 months and 2020. Again, in 2019, that was a rough year for them, but they have rebounded. So here I'm just gonna break down what we're all gonna go over throughout this presentation. So after this, I'll hand you off to Chasten to go through their revenue breakdown, financials, and their key growth drivers, both their gathering operations and their transmission operations. Then he'll hand you off to Hussam, who will go through the valuation, and then Sam will wrap it up with their risks, portfolio fit, our overall recommendation, and a summary. So now off to Chasten to go over their business overview.
Okay, hi everybody. I am Chasten. Very glad to be here with you today. I'm going to break down the business overview for Equitrans, and we'll go over some financials. So first, I would like to say that Equitrans is one of the largest natural gas gatherers in the United States, and the revenue breaks down as the following: gathering operations is 67% of the revenue. Transmission is another 26% of the revenue, and then water operations is 7%. Here I have a graph with the revenue, 2018, 2019, 2020, all pretty steady. 2021 is going to stay the same, but in 2022, when we expect that MVP pipeline to be fully in play and is fully permitted and up and running, we're going to see a big jump in revenue, and we continue to see that growth into 2023 and 2024. As we move on to here we have a graph which is showing the revenue breakdowns. In 2019, it was a little bit larger of a share for the gathering operations, and in 2020, that was cut back a little bit and more into the transmission operations. As well as we see the water operations also gets an uptick in 2020, and that accounts for more of the revenue. Moving on, we'll go ahead and we'll move on to the financials. As we take a look at the financials, the first thing that we can take a look at here is the PE ratio. I know that 2019 might seem like a concerning numbers. You're seeing a lot of negatives. If it's return on assets, PE, a lot of the reasons why they had negative numbers in 2019 was we can tie directly to goodwill charges. They had goodwill charges with the acquisitions of EQT, excuse me, 475 million to be exact, and then there's another goodwill charge of around 108 million. So I mean that kind of affects the bottom line. Anyways, moving on, we still see that the price to book from 2018 to 2019 to 2020 is still lower than the industry average in 2020. So that is something that we thought was very interesting as we're looking into the stock. Another thing that we notice is Equitrans is more profitable than its competitors and to the industry average. So this company is more profitable. We're seeing a bigger return on assets. Their net profit margin is also higher. And one other thing to note is that their debt to equity is also a little bit higher, but their debt is directly tied into the MVP pipeline. The MVP pipeline is what's going to fuel the growth
for this company, and it's something that we are super optimistic about. And it's going to really help with the different drivers. So moving on to driver one, we see that for the driver one is their gathering operations. So it's gathering this natural gas. When they're gathering it, most of their gathering is tied into long-term contracted fees and their monthly charges. So we're not going to see a ton of fluctuation between how much money they're bringing in when they're actually gathering, because it's already contracted. 91% of their gathering operations is contracted. And then the other percentage is with a volume-based fee. So their volume-based is a smaller margin compared to the actual contracted fees. But as we take a look at the graph here, as we see in 2022, we see that uptick in revenue, and that comes directly from the MVP pipeline being fully intact. And like I had mentioned before, that MVP pipeline is certainly going to be what's going to fuel the growth for the revenue. So moving on, as we break down those numbers, 2020 to 2021, we see a slight increase. However, the biggest increase again comes in 2022 when that MVP pipeline is fully up and running. Something that we believe will be up and running by 2022. I know that they said recently in their recent earning calls that it might be after the first quarter that will be up and running, but it's something that we have also factored in. So looking at driver two, the transmission operations, this one is also 97% of negotiated rates that are already negotiated. So like I said, you're not going to see a huge flux in these numbers because they're already contracted numbers. They also have monthly charges. And again, there's also the volume base, which only makes up 3% of their revenue here. And again, as we take a look at the graph, we see in 2022 that transmission operations are also going to see a boost P pipeline up and running. So directly after 2021, we see that MVP pipeline, Mountain Valley pipeline, see the boost. Breaking down the numbers once more, again, going to be a slight boost in 2021 with the recent call earnings. They're right on track with what we have been estimating. And again, in 2022, we'll see that bump. In 2023, 2024, we also anticipate growth with the market for natural gas actually growing over these next couple of years. Next, I'm going to pass it on to Hussam, and he's going to break down the valuation for you guys.
Hi, everyone. I'm Hussam, and I'm going to talk about the valuation. I'm going to talk about the valuation we projected of the stock. And in this figure, it's showing the revenue stream, and it's also showing that gathering operation will make the most of the revenue because of the MVP pipeline. Here in this figure, it's explained that once the MVP gain pipeline fully operated, it would make huge gain in the revenue. And we can see that in 2022, the growth rate would increase roughly by 30%. Here we also look at EPS estimates and on the three scenarios. There is not much to talk about in year 2020 because it's kind of new company. But we still see the huge growth in 2022. Here we look at another method to evaluate the stock, and we see the numbers getting better from year to year. And what's remarkable here, it's the increase in the net profits from year 2021 to 2022. Lastly, here in these two figures, 12A and 12B, we look at the three scenarios in each method, and in figure 12C is combined combined target price, and we weighted 85% towards PE method and 15% towards DCF method, because we believe PE method would give us the accurate price. And now Sam will take place to talk about the risk matrix.
All right, hello everyone. I am Sam. I did chat with a couple of you during the meet and greet, so it's good to see you all again. Here we have a matrix of the risks that we feel are the most detrimental to the success of Equitrans. The two we feel are the most significant, however, are the MVP permitting issues as well as contracting issues. The MVP project has faced some setbacks relating to permitting and water crossing. It was announced this week in their first quarter earnings call for the year of 2021 that they do not see approvals for the necessary permits occurring during the third quarter, as was previously projected. This will unfortunately set back production and result in a new target date for full in-service to begin during the summer of 2022. The new cost of the project is estimated to be about $6.2 billion, which Equitrans plans to fund about half of the overall cost, giving them a little over 50% stake in the project. This will also push back the timing for the Southgate expansion of the Mountain Valley Pipeline to begin construction. All of this said, even if these approvals aren't given until early next year, the current budget, as well as the targeted in-service date, is still an achievable goal. Another significant risk Equitrans has relates to expiring contracts. When their current contracts and obligations are approaching expiration, the company may be exposed to risk resulting from the inability to renegotiate or renew contracts. Should that occur, adverse effects on the business, financial condition, operations, liquidity, as well as dividends to shareholders may arise. Two ways in which this could happen is failure to extend or replace the significant portions of existing contracts, or extending and replacing contracts at unfavorable rates at expiration. However, the significance of this risk may be high, but the probability is quite low. The weighted average expiration date for the existing contracts won't be for another 14 to 15 years, so there is still time to analyze that as we get closer. So now we will move on to the portfolio fit. For the most part, correlations with this company tend to stay in the 0.4 to 0.6 range, indicating there isn't really much of a correlation at all. In figure 15, we have listed the highest and lowest correlations to ETRN. As we can see, there's about a 63% correlation with Turtle Beach, 61% with Emerson Electric, 60% to Booking, 15% with Boeing, and finally a 2% with Next Era Energy. The fund's benchmark allocation for the energy sector is roughly 4%. And right now there is 0 allocated in the fund. So we see this as a great diversification opportunity for the fund to add in a new sector that is unrepresented. The efficient frontier weight for the stock would be approximately 3%. However, we feel best comfortable recommending a weight of a little over 1%, just because this company is on the riskier side and a little newer. Finally, we want to reiterate some key points that we covered throughout this presentation. They are that Equitrans is undervalued in our opinion. We feel its true value to be around the $15 range, though the lower number can be attributed to the uncertainty surrounding the Mountain Valley Pipeline, which brings us to our second point. The timeline for the expected full in-service date was pushed back to summer 2022 due to awaiting permitting approvals. However, this said, we are still optimistic about completion if not earlier than summer 2022. And finally, we feel it beneficial to the fund to add an unrepresented sector. Energy is a sector in which the demand, though it may fluctuate and have uncertainty surrounding clean energy solutions, won't disappear. There will always be the demand for natural gas and oil delivery. To review, we're recommending a buy of approximately 500 shares to ETRN to add to the Spellman Fund. Our target stock price is roughly $9.55, and we project a target return of approximately 27%. And now we'd like to open it up to questions. And thank you to each one of you for taking time out of your schedule to listen to our presentation. Thank you.
Okay, good job. So we have about 20 minutes for questions.
And could I ask just a quick first one? I keep looking at statistics on my other screen as you're presenting, and every time you say it, I miss it as a result because I'm trying to do two things at once. Actually, keep the presentation up.
Oh. Quentin, are you able to put that back up?
See, the permitting was delayed from this summer to next summer. Is that what it is?
It was delayed from like the start of 2022 to the summer of 2022. And that came from Virginia having the permitting issues, where I think Quentin touched on in the beginning, where they can't just get one big one; they have to do individual ones.
So nothing would have impacted your numbers for 2021. Is that correct?
No. So 2021, is going to remain unchanged.
Okay. So what I'm trying to figure out then is, I mean, this stock is really cheap. It has a 7% dividend yield. You may have a catalyst for 30% earnings improvement. It's the type of stock that me personally, why is it cheap? So I kept trying to figure out why is this thing so cheap and why has it gone down so much? One of the things I have on my other screen is just the revisions for earnings. And so back a year ago, this is what people expected them to earn in 2021. A year ago, people were expecting $1.50 for this year. Right now, they expect them to make 86 cents this year. So something bad had to happen over the last year that brought it down. And it can't be the permissioning because that's a 2022 event. So what happened that bring it down? And what I'm trying to figure out is that negative event over? And if so,
sorry, I think a lot of it is with the MVP pipeline. They're over budget a little bit too. I think they're about $1 billion over budget what they anticipated at first. So I think that may have something to play into it.
So over budget on this new pipeline. That's basically hurting earnings currently because you got more costs. Yep. So if you do get to capitalize, is that correct?
Yeah.
Okay. All right. So all this is temporary. And my second question, and then I'll let others ask it. How did you find this company?
So I know Sam talked about it a little bit before, but we knew that the Spellman Fund needed to be in the energy sector. And so we thought, what a great opportunity. So let's do some screening for some stocks as I went on, trying to think if it was Morningstar or a different service, but I used one of their screeners as I went one in the energy sector. And I ran a few other of the screenings through it. And then this stock kind of caught my eye. I saw that other analysts had optimistic things to say about it, said there's really good room for growth. I saw their profitability was higher than the industry average, so it was something that was definitely caught my attention anyhow.
Yeah, I mean, we talk a lot about the Mountain Valley Pipeline and just how crucial that is for the success of Equitrans. And so that played a big part into choosing this company because they have such great prospects of high returns after completion.
Great. Is EQT that merger done? Was that merger done?
Yeah, I think it was completed in 2019.
Possibly there was extra cost or less synergy than they expected of that too. But it's in the number. All right. Well, good job. Okay.
I'll jump in with more of a comment. Could you go to the slide that has the yearly financial ratios on it, please? And I'll make my comment. So looking at 2019, you talked about how the negative numbers were impacted by that merger and the write down of the goodwill. And I think most general accounting practices, that's how you're supposed to report it. But a lot of times companies will also report an adjusted number, which takes out those one-time factors. And that allows you to look at this from calendar year basis and draw better conclusions about what's more of the trend or the ongoing operations of the business and what are the impacts there. So I don't think you did anything wrong in how you displayed it because that's the actual accounting. But just wanted to make that note that a lot of times they'll make an adjustment in their reporting to take out that one-time factor to allow for you to have a better kind of year-to-year comparison.
Thank you for that. I was not aware of that.
I had a quick question. You talked about energy, oil and gas, and then you talked about clean oil, clean energy. I assume when you talk about clean, you're talking about natural gas. Do you have, and maybe you said it and I missed it, sorry. Do you have a breakdown of how much revenue comes from natural gas and how much comes from oil?
I don't believe we do, or I don't, I should say.
No, I don't believe that we broke it down that far. We just have the gathering and transmission operations.
Yeah, that would be one thing I would want to look at because the comps here that you use, Williams and Kinder, they're pretty diverse, even with some other business segments. So that might just be something to think about. And then particularly if you're positioning this as clean energy, I would think you'd want just natural gas, not oil. But just something to think about. But yeah, I mean, it totally looks cheap. Hard to argue with that one. And then I guess what percentage of a probability do you put MVP getting approved and done? Not even on time, but just getting actually approved and done.
We are very optimistic about it. It's very close to done. They just need to get this permit approved, this one body of water, before they can start the expansion projects, which include the Southgate, which I mentioned earlier. So the project is, for the most part, done, but won't be in service until projected summer 2022. And that's like the latest.
If I gave a percentage, I mean, I would say 80-20. I mean, this company definitely has a lot of a substantial amount of money invested in it. And even in their most recent earnings call, they still talked about their optimism about getting it done. So.
Thank you.
Hey, happy Thursday, everybody. It's Casey. I was wondering if we could talk a little bit about the projections moving forward, and specifically the thought process behind your optimistic, your baseline, and your pessimistic growth, I guess, theories, more or less. Like how you came about with those numbers. I kind of see, as you guys are walking through this, you did a nice job. I see this as kind of like a pig in the python type story where, looking at your projections, you have this huge one-time hit of revenue that's coming down the pipe at some point. And it's a pun in some ways. It's about as clever as I can get today. But after that, you get back to it appears to be very slow growth. You know, call it, I don't know what, I think you had like around what's called 3% revenue growth. So I'm kind of curious as to, I think you use 97% of your contracts are already set in place. What kind of pricing power do they have? Like where, once this big event happens, which everybody's kind of waiting for, where does the growth come from after that? Is there going to be much variation in your revenues going forward because everything's kind of set in place at that point? So I was kind of curious how you came about these three different scenarios and really what's driving that variation between the pessimistic and the optimistic.
Yeah, I mean, I can talk about it a little bit. I know that when we talk about like the pessimistic, that definitely came from the MVP pipeline getting delayed more and more. We already seen that they walked back their kind of completion date and when they wanted to be up and running. But we kind of in the middle of, I think it was here April, that they said, hey, we're not going to even have the permits done by just December of 2021. So I started factoring these numbers in, knowing that the MVP pipeline is not going to be completely in play. However, okay, so back to the pessimistic though, that's if that gets walked back even farther. And that's, I started a 2023 fully in service date for that. So that's how we got our pessimistic numbers. And then our optimistic, this was, hey, this is going to be up and running, fully operational by 2022, by that summer start date. And they're going to be having no issues with permitting or anything, going into the ground. They don't have to raise any more debt and invest anymore. So that's kind of where our optimistic numbers comes from. And I'm sorry, what was your second part of the question again? It was a little.
I apologize. I'm horrible at questions. Let's just stop. Let's just stop there because as you're explaining this to me, I got a new question that came from this. So the big jump from your optimistic, I guess the difference between your optimistic and your baseline essentially is you're trying to price into the upside of this project coming online, but you're telling me that it's going to be a 2022 summer event, but you're showing me 2021 numbers. So, let's just go from your baseline. So that revenue shouldn't be hitting, or that EPS should be hitting the 21 number, correct? Or is this just the cost?
Yeah. So I guess that's something we didn't necessarily factor in all the way there, but
I'm curious because it's a pretty decent revenue pickup if you think about it from baseline, 88 cents to a $1.05.
Yeah.
Eddie's better math than I am, but 17 cents, over 88. I can't do the math. We'll just call it 20%, just to be silly. That's a pretty big jump in growth. So I was just kind of curious if it's a 20% growth, where historically this thing's been, you guys are measuring out about 3% growth. I was just wondering what the methodology was behind that, or what the thought process was.
So a lot of that, when we factor that in, it comes to that revenue jump comes directly from what they're anticipating is going to happen with this MVP pipeline. They're anticipating an EBITDA jump of 30%. So we factor that in, and then we take their profit margin overall, and we tied that back into the revenue, and then we calculated it out that way. That answers your question.
Kind of. I understand, once they get this big, I think where you're going is you're going to get this big hit from that project. But once that initial one-time hit, I think it would have been easier for me to understand. I'm the least intelligent person on this call. If you would have maybe taken like the next couple of years and actually shown, here's kind of what our baseline EPS growth is going to be, because then you'd be able to see that one big jump. I think you did it in a different slide where you see the revenue jump and then it kind of slows after that. And so I'd be curious to kind of see what that revenue growth is on EPS perspective, kind of moving off into the distance, I guess into the future. Yeah. So if you go,
I think that I have one overall right here.
Yeah. So here's your baseline growth, and then your optimistic growth. So you're not really seeing, like, what threw me off here was like 2023. So your baseline growth is 2%, but your pessimistic growth is 3%. And then it kind of flip-flops in 2024. Like, there's just some, like, your pessimistic growth rate is 42% in 22 versus, I think you might have something potentially, I guess I'm not following. Okay, I see, because it's off your 21 to 22. Okay, never mind. Okay, I got you now. Never mind. Like I said, it was me being a little slow today, but what I'm trying to figure out is, there's not much variation as you get out, let's call it 2024, in your EPS growth rates. So what I'm struggling with mentally is, how do you, if there's not much variation, maybe there should be, I would think, I guess going back to other people's comments, trying to mentally figure out why the valuation is so low, and is it because of the fact that once you get past this initial project, there's risk around the project being done, but then once you get past that, you're back to being a very low growth stock, which then why pay for that growth? I guess in that case, is it really just, you guys haven't really mentioned it too much, a little bit, but is it more of a dividend stock? And that's why you should buy it, get your 7% dividend.
So I want to add to that. We're really not paying for that. We're only paying 7 times earnings.
Yeah.
So we basically aren't paying for that.
Yeah. Because the market already knows.
That would be where two clients or whatever are disagreeing. Sorry, I should have let the students say you're not paying for that growth.
Yeah. Well, that's kind of the end of the day. The market's already seeing through that, and it was the long way of me trying to get there. So apologize for me, stumbling and bumbling, but that was kind of the point. Once you get past this, here's what you're looking for 23, 24. You have a low valuation because you have low growth. So at the end of the day, this, you're getting a 7% dividend yield. So you could say, well, yeah, we're getting 3%. Let's call it 3% growth per year. But oh, by the way, you're also getting a 7% or whatever the dividend yield is. So net, that's a 10% total return.
Yeah.
Here's your value. Here's what you're buying essentially.
Okay, I would argue that that's 10% post the 30% bump. So I get 30% bump. Let's say your earnings are $1 and your PE 7. Well, if the earnings go up to $1.30 and your PE $1 and PE 7, that's $7. If your earnings go up to $1.30 and you still have the same PE of 7, the price goes to $10 and something. So I get 30% bump up initially and then 10% after. You're going for the 30% initial bump, right?
Yep.
And my guess is a PE of 7 is exceptionally low, which was driven down by all these reduced expectations and people just selling this loser. That would be my opinion on that. And clearly there's people buy it and people will sell it, and one of us is probably right.
I mean, I believe if we got it right now, we would be sitting pretty in a year or so. I think we're going to see this stock skyrocket.
So here's a question for you then. It almost seems like it, going back to this kind of pig in the python thing. So if you're betting on this occurring, and to your point, the stock rips because they actually get the project done. It's done ahead of time or whatever reason. You're playing market expectations, right? So let's say that it's a better outcome than what the market is currently putting in place. Then life becomes, from a 30% increase in EPS, it becomes then that real slow draw of 2%, 3%. Would you then take your profits and move on? Because you've already had the market kind of beating event take place?
I mean, if you're saying necessarily what I would do, I mean, I've always been not the hoggish type. I think once I get a nice return on my investments, I kind of take profits. So in this situation, I think I would. Although I'm still optimistic that there'll continue to be growth, I definitely think with Biden's kind of wanting to move away from the coal, that natural gas could come into play since it emits half this amount of carbon dioxide compared to coal. So I still think that if we could see a move into the direction of natural gas, because it's a little bit better for the environment. So I still think there's but overall, I mean, I personally would take profits because I'm not very hoggish. I don't want to get too greedy. But I still think there would be room for growth, even if we do see that bump.
Yeah, I mean, kind of going off of Chaston, we see this huge growth rate in 2022, and then it kind of like tapers off. And I see that as right now it's more of a risky, uncertain kind of climate surrounding it. And once this MVP pipeline is complete, there's going to be a lot more security surrounding the company and the stock. And so that's why we're seeing the smaller growth rates, if that makes sense. It makes sense in my brain.
Yeah, it's time for maybe one more question. Tyler, did you have something? I saw you pop up on the screen there.
No, I'm good.
Yes, one last quick question from anyone? All right, well, we can end things there. Good job.
Thank you, everybody.
Yeah. Thank you again for taking the time to help us learn.
Yeah, thank you guys.
Thank you.
You guys did great. Have a good day.
You too.
Okay, so we can move on to the last presentation for today. I believe it's our Allstate group. And so whenever you all are ready, you can have someone pull up the PowerPoint and get it started.
Jordan's just going to pull it up here for us. Alrighty, so I'll get started here. Thanks, guys, for taking the time to meet with us today. We are Group 2 and the final presentation for today, and we'll be showing you the research we've done on Allstate as a company as well as their stock. My name is Alex White.
I'm Jordan Stark.
I'm Sam Burns.
And I'm John Parsons. So for Allstate, we'd recommend to buy. We believe that it's relatively undervalued because it has a highly diversified product portfolio, which helps increase the sales associated with its existing product line, and it has immense market penetration in the U.S. and Canada. Currently, the target price is our current price is $132. Our target price is $187, which would lead us to have a target return of about 44%. I'm going to now have Jordan take over, and he's going to be running you guys through our key statistics.
So looking at Allstate and their performance over the past 6 months, they've seen an increase of their share price from $92 to a little over $132 as of today. That's about an increase of about 43%. So that 126 number you're seeing is actually from Monday, and yesterday at close they're about at 125. So their quarter 1 2020 earnings call came out last night and really made their stock price shoot up. Some key statistics to look at before we get into the financial performance later on is their PE, ROE, and EPS. We see these as great ratios for the company in terms of how they compare to the industry average. So now I'll be passing it over to Sam to go over a little bit of the presentation outline.
Thanks, Jordan. So just a quick outline on our presentation. We'll be going over an overview of Allstate's business and be breaking down how some of their revenue streams. We'll be going over some more financial statistics, and then we'll be going over their key drivers for growth, being homeowner growth and reduced auto claims. Then we'll dive into what our valuation for the company is, some of the big risks associated with the stock, and how that stock fits into the Spellman fund. I'll be now passing it off to Alex.
Thanks, Sam. So we thought we'd share a little bit more about Allstate as a whole. Allstate's obviously in the insurance industry, which operates in the financial services sector. They were founded all the way back in April of 1931, and they offer a considerable amount of services within the property and casualty area. So home, auto, renters, motorcycle, identity, condo, business, etc. And then as well as the life insurance area. Last year, they had a total revenue of about $45 billion. And of that $45 billion, P&C is their main revenue stream, contributing to 83% of that total revenue in 2020. Life insurance is their is not their next largest stream, but their largest coverage stream, which contributed to about 5.5% of their total revenue. Other revenues stream from their investment income and capital gains. That contributes to about 11%. As you can see from the graph, the most notable thing to take away from it is the consistent positive growth in all revenue streams. On average, P&C has growth of about 4% over the last 5 years. Life has grown about 2%. And we've determined that the company's overall 5-year growth rate is at about 5%. This consistent growth is a really positive sign for investors, especially given their history of share buybacks and dividend increases due to their excess amounts of net income. To touch a little bit more on their revenues, we'll show on the next slide the pie charts of their revenue streams in the previous 2 years. So transitioning from the revenue growth, here are the pie charts showing the revenue that streamed from P&C Life and their other investment revenues from the last 2 years. 2019 had a total revenue of approximately $44.6 billion. Of that, $36 billion was from P&C, $2.5 billion was from Life, and other revenues was about $6 billion. And as mentioned on the last slide, total revenue grew slightly from 2019 to 2020 to about $45 billion, approximately $44.8 billion. And of that, P&C was $37 billion, Life was $2.5, and other revenue was about $5 billion. Now Jordan is going to talk you through a couple of the key financial ratios from the last couple of years.
Okay, so Allstate's financials have performed exceptionally well compared to the industry average in terms of this year and the past couple of years. We see a very low PE ratio and PEG ratio, which we see value in because we are looking to invest in value stocks. That low PE ratio, especially compared to Progressive, which is a close competitor of ours, we believe Allstate to be undervalued as well. A concern for us, however, is the ROE, ROA, and net profit margin compared to Progressive. Although Allstate's numbers are better than the industry average, we obviously want them to be the best. And something that we consider is their Progressive's debt to equity ratio, which is 33%. It's a little higher than Allstate's, so that's why we potentially see a much higher return on equity ratio. However, they still have a higher return on assets and profit margin, so that's something to consider going forward. And although they do have that, we see that Allstate has better growth opportunities, which we'll be going over in the next couple of slides. But also something to consider is their price to book ratio. Progressive's is at 3.44, while Allstate's is at 1.36. And coming out of the Q1 earnings for this year, it's up to 1.6. And we believe this is another reason as to why either Progressive is overvalued or Allstate is undervalued, and both are incentives for Allstate. So now Sam will be leading us in our first growth driver.
Thank you, Jordan. So the first big area we see for growth in Allstate would be net income generated from homeowners insurance. We are predicting there to be a big increase in demand in the housing market, which can be attributed to a few different factors. Firstly, interest rates continue to be historically low, which we think will motivate a lot of people to buy a house sooner rather than later, as to when the interest rates go back up to their pre-pandemic values. Another reason we see an increase in demand is that a lot of individuals and families have delayed their house purchases due to the pandemic. With the COVID vaccine being rolled out and people's job security becoming more certain, we expect those people who have been waiting to finally buy a house. One of the effects of COVID has been an increase in remote working, and we expect that companies will continue to utilize working from home, which in turn will lead to more people purchasing homes as opposed to apartments, so they can have bigger working areas or office spaces. And along with our prediction, the Washington Post states that the housing market sales are expected to grow 15% in the next year. So on this slide, we go into some of our projections for the net income derived from homeowners insurance. So how we found this is we found Allstate's market share for homeowners insurance to be 8.2% based from IBIS World. And then we also found that Allstate's profit margin for homeowners was 10%. So by taking the total homeowners industry revenue of $108 billion, multiplying that by Allstate's market share and profit margin, we're projecting $866 million of net income for homeowners insurance in 2021, which is up 7.5% from 2020. And the reason that we see such a big percent increase in net income from 2020 to 2021, and then a little lower from onward, is 2020 was a bit lower just because of the pandemic. Like I said before, people were delaying purchasing houses. So we think we'll see a big jump in this next year, and then it'll cipher off to around 6% growth from the years on after that. And now John will be going into our second growth driver.
Thank you, Sam. Our second growth driver we're going to be talking about is automobile insurance. We've seen an increasing in automobile safety technology across all insurance industry, or the whole entire insurance industry. Due to this innovation in technology, we can also assume that there's going to be a decrease in the number of car accidents. And with that, Allstate has also seen an increase in other revenues from investments by 3%, which is to be expected when interest rates rise with the recovering economy due to COVID. And on top of that, within the next year, we'll also see a 1% increase in net income due to our projected 1% increase in premiums. So we took our market share from IBIS World. We got 7.5% for that, and our profit margin is sitting at 14%. Then we found the industry revenue to be $311 billion, and we took our market share and profit margin, multiplied that by the industry revenue to get about $3.2 billion for net income. And as we said before, 2020 was definitely an anomaly year, and especially for auto net income. For 2020, our net income was $3.4 billion. So we were forecasting a drop for 2021, which is that 5% decrease. And for the following years to come, we'll see that it will probably rise back to about 1% all the way through 2024. With that, I'm going to pass it over to Alex, who's now going to be talking about our valuation.
So here on this slide, figure 9 shows just a breakdown of each revenue stream that we foresee to be the biggest growth opportunities for Allstate. As you can see, the percentage contribution of each segment stays relatively consistent throughout the years, with auto obviously contributing to the majority. So next, we're going to look at the growth rates for these drivers. Similar to the net income growth rates, we're projecting about average of 3% EPS growth over the next 4 years based on our revenue increase projections in the home and auto revenue streams. The growth rates for 2021's EPS for homeowners, like what was stated before, is a bit larger just because 2020 numbers were a bit low. So we're using that 7.5% growth rate to bring it back to a normal level, and then 6% thereafter. And like John said, 2020 auto numbers were abnormally high, so we wanted to decrease the percentage growth for 2021 to normal out the numbers a little bit with a 1% increase thereafter. So on the next slide, we'll show what our actual EPS projections were through 2024. So real quick here, you can see our 3 different scenarios: baseline, optimistic, and pessimistic, and what our ending 2024 EPS projections were. So shifting into our next valuation method, you'll notice that we are projecting an increase in all areas for our discounted cash flow valuation, other than the changes in net working capital, which has historically been very staggered for Allstate. So that's how we wanted to project it. The bottom line of the discounted cash flow method shows terminal value of $81 billion and $68 billion for our 2 different free cash flow methods. We will get into what these numbers essentially mean on the next slide. So I'll touch on where we first got our PE estimate from. We projected our baseline 2021 PE estimate to be 9. It's sitting at about 7 right now, and we project 9 since we believe the value of the stock is going to increase over the next year, and people are going to be willing to pay more for each dollar of earnings. For the pessimistic view, we lowered that 2021 PE forecast to be only 8 for the chance that Allstate's value doesn't increase like we expect it to. And on the flip side, for the 2021 optimistic PE estimate, we have it at 950 because that's what we feel is the absolute most that or that investors will be willing to pay for each dollar of earnings by next year, regardless of how well the company is doing. Taking a look at the next figure, we decided to use a 70% weight on the PE price method, as we think this gives us a more realistic view. But this gives us a target price range between each scenario of 165 to 199, with our baseline falling right in the middle at that 186. As you can see, the current price after the last earnings call was $132, which gives us a return on our baseline target price of about 44%. Jordan now is going to run us through a couple of the risks that Allstate faces.
Thank you, Alex. So on this chart, you can see some of the risks that we see could happen and their significance. I want to first touch on the drastic increase in claims because that's something that we have been talking about. We see this as being a high probability, but not completely, not being a total downfall for Allstate's stock price. As things start to open up again, we see a lot more drivers on the road, and that means the probability of claims being much greater than this previous year. But something to note is that although we see an increase in claims from 2020, this could still be a decrease in claims from 2019, which would be a good thing for us. Next, I want to talk about their recent acquisition of National General in earlier this year in January. So from this acquisition, they wanted to not only gain a 1% market share in auto insurance industry, but they also wanted to utilize the independent agency technology that National General uses. This is a market that they've been trying to access for the past couple of years and have done so through acquisitions in the past, but they have not been able to gain a foothold in this market. And if they can't, this might be a poor acquisition in the end. The next one I want to highlight is the captive agents. So one thing that could happen is captive agents lose their value, and this is because many competitors are shifting towards independent agents and direct channels. And one of the good things is it is believed that Allstate has a niche in this captive agent market, but it's clear that with their acquisition of National General, they see a decline in the use of captive agents in the future, because that's why they want to access the independent agent market. And lastly, I just wanted to touch on the corporate bonds. Nearly half of Allstate's investment portfolio is in corporate bonds. So in the case of an economic crisis, Allstate could see substantial losses due to defaults in these corporate bonds. But the probability of that is fairly low, but it could happen, and it would include substantial losses for Allstate. I'll now be passing over to John, who will be looking at the portfolio fit.
Thank you, Jordan. So as you can see for our correlation matrix, as you guys have probably seen already for the past other presentations, we have a relatively positive correlation all throughout this matrix. For Allstate specifically, we have no negative correlations with any of the other stocks that it's being correlated with. And on the next slide, I'll be showing you what some of our highest and some of our lowest for that. Of the highest, you can see that Prudential Financial has the strongest relationship with Allstate, and for the lowest, we could see that Turtle Beach has one of the lowest relationships with Allstate. For our optimal portfolio weight, it's about 5%, which is roughly about $20,000 worth. And we would recommend that a more reasonable purchase to that would be about $12,000 of Allstate. And for that, we would sell $8,000 of Apple and $4,000 of Disney to make room for this Allstate investment. Sam's going to be finishing this off by summarizing our findings.
Thank you, John. So to summarize everything up, we think Allstate has a very promising stock outlook. As mentioned earlier, they have a 6-month return of 43%, showing that already just in the last year, we've seen a lot of growth from this stock. And Allstate also has a history of doing stockholder-friendly activities, such as buying back shares and increasing their dividends. We see 2 big growth opportunities in the auto insurance and homeowners insurance that we think will lead to higher profits in the future. And in addition, the stock has a low PE and PEG ratio compared to the industry, along with an above average ROE, which shows that this is a value stock. So our recommendation is to buy 90 shares of Allstate In order to make room for this, our original recommendation was to sell 63 shares of Apple and 22 shares of Disney. However, the class, we had kind of a group consensus where we did a buy, sell, hold on all the stocks in the Spellman fund. And from that, the class came to a consensus to sell 83 shares of Apple. So that's kind of already been taken care of. We would still suggest looking into selling Disney since they're one of the more highly correlated stocks with Allstate, and the industry that they're a part of makes up a large portion of the Spellman fund. But we are projecting a price of $186.52 for Allstate in 1 year, and which would yield a 1-year return of 44%. And on the surface, this looks like a really high return for 1 year. But as I said before, Allstate has already grown a very large amount in an even shorter amount of time. And we kind of view this $186 as the intrinsic value of the stock. And it may take a little longer than a year to get there, but that is what we think the stock will eventually end up at. Sorry. And with that, I'll open it up to any questions.
Okay, nice job. So again, we have about 20 minutes for questions.
I'll do the first again since there's a pause there. I think you guys said, I'm trying to remember what you said, why 2020 earnings are up a lot. Why is that the case? I have my own reason. I pulled up your executive summary, kind of to read again what you're saying, but why are earnings up so much? And then 2021 are supposed to be down.
So maybe one answer to that question could be that they paid out a lot less in terms of.
There you go. Keep saying that. I know what you're going to say, but keep saying it.
So, I mean, obviously they pay out a lot less on their bottom line. It's going to be way overinflated if they're paying out a lot less compared to what they normally do in years. So that was kind of our consensus. We probably should have mentioned that as to why it was so high, but that's essentially why.
Yeah, their earnings went up about 40% in 2020. And remember, like my State Farm sent me a check. I literally didn't drive one car for 3 months.
Exactly, which is why there's less people on the road, less accidents, less being paid out, but people are still holding their premiums. So.
Okay. All right. I think you nailed it. Excellent. You understand the business. Can you go to, and I'll ask my second question, can you go to the slide where you talked about those various growth rate? I think like housing, 7.5%, auto, -5,
Yeah, so we can bring it to just showing our EPS growth rates, which is actually the same as our earnings growth rates.
So this is me challenging you. The other was you getting, the question exactly right, I think. So if we had a great housing market last year too, by the way. I mean, it's just continuing to be great right now. But we don't actually build like 7.5% more homes each year. People move from one home to another. How are they going to get 7.5% growth rate?
So we foresee a lot more people moving out of their apartments, moving out of their duplexes where they're paying rent to actually buying a home and starting to open up these policies on homeowners. I think we mentioned that now that more companies are permanently moving to telecommute positions, that people are not going to want to be cooped up in their apartments or smaller living situations. They're going to want a bigger house with more room. And for that reason, more people are going to want to have homeowners or insurance. And for some reason,
go ahead.
I'm sorry, I missed what you said.
No, go ahead.
We think that in 2020 it was a relatively low net income for homeowners on Allstate's end, and we think that more and more people are going to be continuing to buy houses throughout 2021, more so than we've seen in prior years. That's why we're projecting that 7.5%.
All right, but I just want to point out, let's say there's 330 million people in the country, let's say there's 2.5 people per household, right? Maybe two, because there is, all right, so that would mean there's 150 million or so households. 60% of those are homes, okay? I know these statistics are approximately right because I wrote a paper on this stuff. So let's say there's 110 million homes, okay, to be able to insure. We're adding, 1 to 2 million homes a year. That's 1 to 2% growth. And you have a 7.5. So the only way they're going to get to 7.5 if the market's only growing 1 to 2%, and these are approximate numbers, is if they're gaining a tremendous amount of share of the new homes. They can get there, but they'd have to be capturing an enormous amount of share of the new homes.
That's very true. Yeah.
Okay. All right. So that's my challenge. Just give you something to think about. I'll let others ask. Oh, by the way, this stock is very cheap. It's 20% cheaper than the peers. And selling Disney, a big winner, to buy this one that could benefit from higher interest rates. It wasn't a driver, but it's a big driver of all financials because they get a lot of their earnings from actually their bond portfolio. Interest rates go up and these things rise. I don't own Prudential. My dad does, which is in the portfolio. I bought a different one. He likes to rub it in that I didn't buy Prudential. But I did buy the other one and it went also up a lot. All these will benefit from higher interest rates.
Hey, this is Casey and the cat. Cat wants to know, along with Tyler, what has been the historical PE rates? Because I guess what I'm trying to wrap my head around is, I think you kind of came up with, 3%-ish, we'll call it a blended 3% growth on EPS, but you're looking for 47% increase in the stock price, which it's going to have to come from, I think you mentioned it, PE expansion. So I'd like for you guys to kind of walk me through how that PE is going to expand and why investors would want to pay up for essentially what you said is 3% growth year over year.
Yeah, definitely. That's a really good question. To go back to your first question, what has PE historically been at? It's been about 7 historically. To get into your second question, why we're seeing that expansion in PE, we think that people are definitely going to be willing to pay more for each dollar of earnings, especially because just in the last 6 months, the stock has returned about 50%. Even when we started doing this project and we first chose Allstate as a stock, they were trading at about $115. And just yesterday, they were at 126. Now they're at 132. I think that trend is going to hold true with this continual increase. I think people are definitely going to be willing to pay more for it for each dollar of earnings, which is why we see that expansion in our forecasts.
I guess I'm curious. Okay, so you're going from a 7 to, like, I think you had a 9 PE, so you got a two-turn multiple increase. And I'm just kind of curious as to what I actually looked this up because I was kind of curious as to what the mighty Google would tell me, or the Investopedia, what tends to drive PE multiples higher. Because you have essentially a two-turn from a 7, an average of 7, and you're taking it to 9.5, 9, so 16, $30. So we'll call it $30 is kind of your PE expansion due to investor enthusiasm. So based on that, I think, you said what, 130, 132, 134 is kind of what I'm showing. Got a couple bucks after hours, I guess that's what the difference. So you got an extra $30, so that puts you at about your $164 price target. which, am I looking at that right now that I'm looking at this on figure 15?
Figure 15 looks like there's a typo there. The pessimistic and optimistic should be switched.
Okay.
Obviously, that's on our, that's just a typo on our end.
Yeah, okay. So your optimistic is about 160-ish, which
Optimistic is about 199, pessimistic is about 165. Yeah, sorry about that.
okay, so that's using the PE and the DCF. Okay, now I got you. I was looking left or right, and that's what was kind of throwing me off.
Yeah, we're weighting the PE price estimate a little bit more, just because we see that as a more realistic view than what our DCF estimates gave us.
Okay. Yeah, that was another question, is just how did you guys, what's the methodology behind how you end up making that weighting decision? Because obviously it could, when you have such big differences in values compared to, I mean, you're optimistic is what, almost $300. That's
yeah.
I mean, that's more than a double from the 132 that the stock is today. So I think any time in life, and this is more of a life lesson, when you see huge outliers compared to what is current day reality, sometimes you need to put less weight on that, because the likelihood of that being realistic is probably less true than what you think. I always harp on people when they show like averages and they have one huge outlier that swings the average out, and they use that as their argument as to why something is undervalued or overvalued, etc. So be mindful of that later in life.
Sounds good. Thank you.
I'll stop there for anyone else. I might have some more, but I'm sure Dr. Brooks wants to get in at some point.
So I wanted to chime in real quick, because when I look back at the price to earnings ratio, I only see it at 7. 2 points in time over the last 10 years. I see it more as a 10, 12, 13 kind of a PE ratio historically. I think when you're using a 9, it comes in a little actually conservative. But then I think the flip side of that is on the earnings outlook. And we kind of talked about this. On the surface, this one looks really easy because it has a long history, slow revenue growth, fairly stable expenses and things like that, claims and expenses. But it gets a little wonky here when you acquire National General, you sell off your life insurance and annuity business, and you have a period in time where people stop driving. And so, and I missed some of the questions that Kevin was asking, so I had to take another work call, but did you guys talk about the combined ratio at all?
Did not yet.
Can you, if you didn't already?
Yeah, so
okay, so
go ahead, Tyler.
No, I was just going to ask, where is that combined ratio today? Where has it been over the last couple of years? And maybe just explain to the group what that is and why the earnings were so high the last couple of years, or the last couple of quarters.
Yeah, so over the last couple of years, the combined ratio was sitting around. This written down. Was sitting around mid 90s. So about 92 in 2019, 93 in 2018, and in 2020's most recent quarter, so quarter 4 2020, their combined ratio was sitting at about 79.3, which is historically pretty good. Just
for the group, because we don't all cover insurance companies, what does that combined ratio mean? What is that ratio?
Oh yeah, sorry about that. So if your combined ratio is greater than 100, it means you're paying out more than you're taking in. So it's the claims and the losses divided by the premiums collected would be what the combined ratio is. So having a combined ratio of 79 is historically very good for their final quarter of 2020. And then the ever so slight increase to about 83 for the first quarter of 2021 is great. And in the prior years, it was in the mid 90s. Now we're sitting at about the mid 80s. Hopefully within the next few years, that trend of improving their combined ratio can continue. One concern that someone might have by having such a positive combined ratio is their pricing still competitive in the market? And that's a question that was actually asked in one of their earnings calls, and their CEO, Tom Wilson, stated that they foresee their combined ratio continuing to improve, that their prices are most definitely competitive and are only going to become more competitive in the market. So I think that's definitely an important aspect to touch on in terms of the business overall. They're definitely very profitable in terms of overall combined ratio.
Another thing to add on the pricing is just that compared to their competitor Progressive, they offer lower premiums for people with lower credit scores, but also with their acquisition of National General, they have been trying to provide a wider range of products, which they're looking to, or it has seen an increase in revenue just from this first quarter from their earnings call.
And how would you view the last two quarters? I mean, you mentioned the trend towards the better combined ratio. Is that sustainable? Or do we think, when you look at your earnings forecast, where you kind of expect a reasonably significant pullback in earnings before we stabilize and sort of return to trend? Or does that gap between premiums collected and losses/claims, does that sort of stick at somewhere just below 90?
I think you were kind of breaking up a little bit, but I think I got the gist of what you were asking. Jordan, if you want to start us off, go ahead.
I was just going to point out, I think since we saw, I think it was like 3.5 points increase from just quarter 4 in 2020 to quarter 1 in 2021. I think that shows it's going to go back to close to where it was. I think with the CEO saying that they have been improving their combined ratio is a good outlook to see it come down. But I think over the next couple quarters, it should probably go back to maybe 90 or close to where it was before. But I think with how they have been performing and how the outlook is going forward, it should be going up, but then also back down, hopefully.
Yeah. To touch on that a little more, like we were talking about before, the reason their earnings in 2020 was so inflated was because they paid out so much less, which affected their bottom line. Paying out so much less affects their combined ratio, which is why it was astronomically lower than what it is normally around the mid 90s. They finished their fourth quarter of 2020, like I said, at about 79. Kind of like what Jordan was touching on, bringing it up in their first quarter of 2021 to about 83 shows that it is stabilizing back to their normal combined ratio level. However, it's still an improvement. It's still showing improvement year after year. And I think this year their earnings are definitely going to increase, holding this about mid 80s combined ratio to hold true.
Can I ask one more thing? You said something about, or maybe one of the other people asking questions said something about them selling off the annuity or some other business? Can you just discuss this a little bit more, and when did this happen? How is that impacting earnings? Give me a better flavor of that.
Yeah, definitely. So they sold off their life and annuity segment in their quarter one of 2021. That actually forced them to have a loss. Exactly what the loss was, I do have it up here. It was
4.1 billion.
Oh, 1.4 billion was their loss.
How big was that business?
It was of their entire revenue in 2020. It was only 5% of their entire revenue stream. So,
all right, I interrupted you. If you were going to say other things, go ahead.
Oh, no, you didn't interrupt me at all. Their life insurance, they sold it off in this most recent quarter. Gave them a loss for this quarter in terms of absolute bottom line of their company. But to get into your next question, life insurance is obviously only about 5% of their entire revenue stream. So in the long run, I don't think a negative loss is going to continue. I think just in quarter one, that was how it was going to unfold for them, given that they're selling off this segment.
All right, so I just was trying to figure out what is normal earnings for them and get an idea. So it wasn't big enough for you to talk about in the paper or presentation. I'm fine with that. I looked at the stock chart, and it pretty much kept up with the S&P 500 until 2020. And to do that as an insurance company was pretty good because interest rates had been going down, for a decade. And then I looked at their sales trend, and they actually had rising sales, and then earnings went up way more than sales. What do you think was the key to their success? The 9 years before, last year, you had a high earnings because you had low losses on the auto business. But what would, if you get good growth going forward again, and this thing's trading at a 10 PE on 2021 numbers, would be enormous. So what was the key to their success literally the 9 years before last year? Why did their sales go up? Do you know?
Maybe a key to their success is perhaps what we mentioned very early in the presentation was the plethora of services that they offer underneath the property and casualty umbrella. That could definitely be it. Their competitive pricing, like Jordan stated, I think he's going to jump in here.
I was just going to add, they also have been acquiring other insurance companies to stay competitive. And I know one is Encompass, and the other one was Esurance. And they're trying to stay competitive with everyone. And just I believe Esurance was to increase their profile online. And then National General is to get into the independent agency market. And I think being able to keep up with what they see is going to be the future has been able to increase their sales and revenue.
Just a warning on buying companies through acquisitions. Most academic studies say unless someone does this frequently, that leads to underperformance of stocks. And if you buy a company, you may issue new shares. So it's really the earnings per share that we care about, not just that earnings go up because I have a bigger company, but I may have more shares. This company's book value per share went from $48 in 2015 to 2019, 74. I mean, that's pretty good improvement. And their margins had been, improving all during that period of time. And of course, they went way up last year.
Yeah, I think one thing that they have been doing is buying back a lot of shares. specifically.
You
I
said
know
that.
they did in 2020, but I don't know when their plans started exactly, but they have been buying back shares progressively. And I believe in their earnings call today, or yesterday, their buyback of, I don't know exactly how many shares it was. I don't want to say the wrong number.
And let me say this. Their actually earnings went from 2.2 billion to 4.8. So their earnings went up more than the book value per share went from 48 to 74. What that tells you is net income may have gone up because of these acquisitions, but shares went up more than net income. And they had to buy back a whole bunch of shares just to offset the extra shares probably from the acquisitions. So fortunately, they bought back shares, but it actually just went to offset some of the new issuances probably from the acquisition, is my guess. So I got to think with this size of company, that's not all stock option plans to management. That'd be pretty hefty compensation.
Something else pretty interesting with their acquisition of Esurance, in my opinion, I think that was a pretty strategic acquisition because I believe they acquired them and then shortly after kind of dissolved it, probably because of their competitive nature that they saw with this online insurance trend, that they didn't want to have them as a competitor. So if you can't beat them, buy them, I guess was their seemed to be their logic when thinking about acquiring Esurance, because they soon after dissolved that side of the business that they recently acquired. So I think that was really strategic and contributed to their success over the last few years.
And I would think someone else could just start up another one though, or did they wrap that into the rest of their business? So they take Esurance and take their technology and put it into Allstate?
Not answer that question confidently. I would like to think so. But like I said, I'm not 100% on that.
Okay. Well, I really appreciate the maturity and how you answered that question when you didn't know. I mean, that was really good. All right.
Thank you.
All right. Anyone else have anything? I guess we're a few minutes over, but it's the last group for today.
I would say real quick, I would agree with that. When you're presenting, if someone asks you a question you don't know, they really do appreciate an honest, you know what, I'm not 100% sure, but I'll get back to you, than trying to wiggle through it. And then I would just ask, John, is this a hometown pick?
No, it's not. No.
It's close. It's not far from where you grew up. And then lastly, I would say, don't be afraid of bonds, guys. Okay. I spoke earlier about what I do for a living, and this is that would be a similar role. You could work at a company like that and pick their investments. I'm half being cheeky with that, but in all seriousness, bond prices, your worry is what happens to corporate bonds, and valuations for corporate bonds similar to equity is kind of elevated right now. But bonds do benefit in crises. So you get that interest rate component. You might have the credit risk sell off, but if you look at actual returns for corporate bonds in 2020, they were pretty strong. So I guess I wouldn't put that as high as a risk for you guys, but I thought you did a great job. And I know we're over, so I won't waste any time, but I didn't have any questions, so I didn't ask any, but you guys did great.
Thank you. Really appreciate that.
I appreciate that.
Thank you.
Thank you.